1. Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers, where I challenge you to replace a 10th of an hour of billing with a 10th of an hour of learning. For today's episode, episode 9, this will be the first part of several discussions on the basics of the generation skipping transfer tax. Now, I emphasize basics because we're not going to get into advanced topics surrounding the generation skipping transfer tax in this series. More, we're going to focus on what are some of the basic terms, provisions, requirements, so on and so forth, so that you get kind of a layperson's understanding of it and come away with enough knowledge to be dangerous when it comes to generation skipping transfer tax planning. So throughout this discussion, I'm going to abbreviate it down to GST tax because it's a mouthful to say generation skipping transfer tax every single time. So why is there this tax? Well, let's assume that in a hypothetical world that's not related to our current state of affairs in the transfer tax world, we're going to assume that there's no estate tax exclusion and the estate tax rate is a flat 50%. So if that were to be the case, then if there was an estate of $10 million held by the first generation, and the growth of which is completely assumed or consumed, the following would be the tax results across 3 generations. First, Generation 1 has $10 million, then upon their death, a 50% estate tax comes out, and that leaves $5 million for Generation 2. Now, Generation 2 then at their death has $5 million. You have another 50% estate tax that takes a bite out of that. And then finally, when you get down to Generation 3, they only have $2.5 million remaining of the original $10 million that Generation 1 had. Now, if the transfer had simply been from Generation 1 to Generation 3 in this case, you could have removed a layer of estate tax and doubled the amount received by Generation 3. But in response to that, Congress passed the GST tax back in 1986. So, for transfers after October 23rd of 1986, this tax applies to transfers that are to or for the benefit of skip persons, as we're going to look at for the bulk of the rest of today's discussion. Now, any transfers and trusts created prior to this date are grandfathered and are considered GST exempt trusts, which is going to be kind of a high basic, low advanced type of discussion in a later episode. But it's important to note that the GST tax applies concurrent and parallel to the gift or estate tax. So with any transfer, you can have either a gift tax for a lifetime transfer plus a GST tax, or you can have an estate tax for a transfer at death plus a GST tax. Now we'll get more into some of the tax rates and exceptions and exclusions later on, but it's important to note for the time being that the actual taxable events where this tax can apply are as follows. 1, a direct skip, which we're going to later see as a transfer directly to a skip person or to a trust where only skip persons are beneficiaries, or you can have from a trust a taxable distribution or a taxable termination. Both of those are events where you know exactly how much is benefiting skip persons, so at that point the tax can be assessed. Now, an indirect skip, as we're going to see later on, is not a taxable event, but is an occasion where the GST exemption, which we're going to later discuss, can be applied to a transfer. So the whole core of determining if there's a GST tax liability is determining whether the recipient is a skip person. So throughout these episodes, I'm going to refer to the transferor as the person making the transfer, because that's how they're defined in the tax code provisions for the GST tax. And the transferor could be making a transfer either during life or at death. So unlike the gift and estate taxes, which are split out separately, there's no separate GST tax for lifetime gifts versus transfers at death. The same set of rules for the GST tax apply to any transfer during life or at death. Now, if the recipient of a transfer is a descendant of the transferor's grandparents, and is 2 or more generations younger than the transferor, then that recipient will be a skip person. Now, if the recipient is not a descendant of the transferor's grandparents, but is more than 37 and a half years younger than the transferor, then that recipient will also be a skip person. But there's a couple exceptions to these 2 general rules. One is that a spouse or former spouse of the transferor is never a skip person, regardless of the difference in age. And 2, a spouse of a skip person recipient is also a skip person regardless of the age difference as well. Now, one of the confusing things with the skip person definition is the deceased parent rule. And really the spirit of this rule is that the GST tax is designed to only apply when there's an intentional skipping of a living person in a generation. But on certain occasions, if a skip person's parent, who is related to the transferor, is deceased, that skip person could move up to their parent's generation and then may no longer be a skip person. So in order for this to apply, the parent must be deceased at the time that the transferor incurs gift or estate tax liability for the transfer in question. And 2, if any collateral heirs are involved, nieces, nephews, grandnieces, grandnephews, etc., they can only move up to their parents' generation if the transferor has no living descendants. Now I'm going to really quickly discuss indirect skips because this will be a segue into later episodes, but most transfers to trusts are going to be indirect skips because with most trusts you have both skip persons and non-skip persons as beneficiaries. Now, I briefly alluded to this fact earlier, but when there's a transfer in trust, it's impossible at the time that the trust is funded to quantify the amount that will ultimately pass to or for the benefit of skip persons until there is a taxable termination or a taxable distribution. And we'll look later at how the rate of tax is applied at that time, but as a result, there's no GST tax liability on the funding of an indirect skip, only on direct skips. So later on we'll look to the reporting and application of the GST exemption. So that's it for today's discussion. Key takeaway would just be remembering who is a skip person with respect to the transferor in any situation where the GST tax could apply. So as always, if you have any questions or topic suggestions, please email me at griffin.bridgers@gmail.com. But thanks again for joining us for this episode of the 10th of an hour, and I look forward to seeing you in the next one.